now joining.
And I think
Hello, everyone.
the host too.
It's Thursday again, the 2nd of May, 2024. I'm coming to you from Salt Lake City, Utah. Chuck's coming to you from Texas. Our presenter today, Nick, is also in Salt Lake, and the rest of you, as far as I know, are in California. So welcome, welcome.
I'm from Montrose, Colorado, Wayne.
Oh, I thought you were in Texas. You're in Montrose?
Yeah,
Oh, I love Montrose. That's cattle country.
yeah.
That's a nice place. I'm sorry about that, Chuck. I stand corrected.
That's
we got
all right.
Got Colorado represented here. That's good. All right, today we're going to, we have Nick back to give us round 2 of seller finance. Last week we talked about assumptions, particularly of government loans, but also of other loans, qualifying assumptions. This week we're going to talk about seller financing and how you can look at the debt that's already in place on a property and retain that at favorable interest rates to make the house saleable going forward, and to do that in a very professional way that limits liability and works out for the people involved, and especially a way to illustrate to the sellers and the buyers why that's to their advantage. So we appreciate Nick being here again and spending his time with us. I will tell you guys at the end of it, I'm going to do a little commercial for him. He can't do this all for free, so if you end up wanting to use him in a transaction, you can work out some kind of a fee structure with him, to a small referral fee or something, to make it worth his time and to compensate him for what he's done in developing all this. That's a small thing, I think, when it becomes the trigger of the transaction and makes a deal come together that just flat out wouldn't have or couldn't have otherwise. So unless any of you have any questions or some housekeeping we need to do before we get started, no, I will turn it over to Mr. Welland and show us what you got there, Nick, for round 2.
All right. Thanks, Wayne. I'll appreciate it. Let's share some slides here. So we got some visuals to go with it. Let's see. All right, this might take a second to load. So while it's doing that, one of the reasons I'm excited to share this back to back is because it can be supplemental to what we talked about last week with the loan assumptions. It can be another tool that you can put in your belt. One of the things later in the presentation here that I'll show you is how you might be able to incentivize your clients, assuming you're working with a seller in this instance, to stay in the deal, keep their financing in place, because there can be a pretty big benefit for them. So let's see. All right, are these slides showing for you guys? You see the main?
Looks good.
Okay. All righty. So this is a massive topic that has many different facets. Wayne has what, 40 plus years of this now, basically?
Yes, sir.
It's never ending, and we're going to try to cover just 30,000 foot view here in the next 30 minutes. So if nothing else, I want to kind of paint the picture here. We'll talk about why seller financing is advantageous to both buyers, sellers, and yourself. For me personally, I always like to see examples because it helps me conceptualize things. Like everything else, equal, or what's the nothing is without its equal and opposite reaction, right? So there are challenges to seller financing. So we'll spend a little bit of time talking about that, and then we'll open the floor for questions. But one of the things I love most about seller financing is it kind of like this Tempur-Pedic, or kind of like this adjustable mattress here, or like the climate control in your car where your passenger gets one setting and you get a different setting, is you have so many different things that are available to you no matter what side of the transaction you're on. You can really dial things. It's almost like having a different dimension. It's like playing chess versus checkers. And when you're in a competitive market, it's a huge way to get an advantage. I'll blow through my background real quickly. Some of these slides are, I use a template that we used last time, but I've been in real estate since 2018. I've done a lot of wholesaling. Seller financing is why we're here. I've spent half a decade at Fidelity Investments, got a degree in engineering, and I love coaching and training. So, all right. What is seller financing? Seller financing is when instead of two parties, a buyer going to a bank and getting traditional vanilla financing in place, they go directly to the seller, and they work out terms. So it changes a deal when you're doing a deal the traditional way. It's kind of like a tug of war. You really only have one dimension for the most part that you're negotiating on, which is price. And yes, there's little concessions you can do, right? Like, oh, we'll paint the house, we'll change the carpet, whatever. But all of these things are focused on the same thing. It's the same bottom line, and it creates an oppositional environment. But if we go to seller financing, for those of you that were there last week, maybe some of you, let's try to involve you guys a little bit here, because I want you to be engaged, and I want you to be thinking from a problem solver mentality and thinking of different ways to tackle things. So what are some dimensions that we talked about last week? We had purchase price, right? We had interest rate. What are some other things that are important when there is a financing in place? What are some other components of a deal?
Hey everyone, if you don't have a noisy background environment, take your mute off, please, so that you can participate in the conversation. If you've got background noise, then thank you for muting, but otherwise, pop off the mute and be fully participative here, okay?
Timing,
Sorry, say that again, Debbie.
timing,
Timing. Absolutely. Absolutely. So we got timing. What else?
Security.
Security. Security. Okay. Absolutely. Security is super important to both buyers and sellers, right? What about from a mathematical standpoint, from a financing standpoint? What
Interest rate.
interest rate? Debbie, did you throw one out?
I said cost, fees.
Fees. Absolutely. How much money do you think is involved when you finance a deal traditionally with Wells Fargo or whatever? How many different people are involved there, and how many people need to get paid in those transactions?
Nick, I calculated that once on a 7-story office building we were building in Anchorage, Alaska, struggling with the construction financing and trying to make it all work. And I had a little Mac 512 computer with I think it was 8 different floppy disks I put in and out of that thing to build my spreadsheet for that building. One day I just got frustrated and thought, what percentage of the cost of this whole thing is financing? If we had our own cash, how much would we save? It was 15%.
It's a
Now
huge
that included the interest over the period of a couple of years, but 15%. And that's the day I think that the seeds of the be the bank formula were born for me, is that if I could ever get in a position where I could eliminate all of that, you got a 15% head start on profit. That's huge.
huge. I mean, think about it. You walk into a bank, banks literally do nothing except connect the dots. And they have these opulent buildings with these pillars. There's all sorts of money in a bank, and they're not building anything. They're not physically producing anything. They are producing value by connecting the dots to allow party A and party B to do a deal together. So what if you were to find a way that you could cut all of them out? Do you think there's some extra money to go around for everybody if you're able to do that?
For sure.
So back to back to the slide at hand here. So a couple other things that are available. Most loans are 30 years now, right? Most people are doing 30 years. Sometimes people do 15. But there's all sorts of other variables that are involved here. A down payment. A down payment is something that you can negotiate on. If someone, kind of like what we talked about last week, if you were able to get a lower interest rate, you're probably going to be willing to pay more for a home, right? So the point I'm trying to illustrate is going from tug of war, where it's oppositional, to putting everything on the table. This is the foundation of the exchange philosophy, is putting everything on a table and moving forward in a collaborative manner. So that is at the heart of seller finance here. So the reason I put these images here, for one, all right, when people think negotiating, especially if they're newer to the game, a lot of times the first thing that comes to mind is this, right? You might think the Donald Trump, like, hard ass, like they're gonna try to go for everything, right? But I like to think of it as Oprah Winfrey. People come on Oprah's show because they know that they're going to be heard. She's going to ask investigative questions. And in my opinion, you can serve your client more by understanding what exactly their big vision is. If you just go in there and you're just selling a house or buying a house or whatever it may be, there's nothing particularly special about it. You're limited on how much you can help them. But if you can really dive deep into the problem and see what they're looking at long term, you have all these little dials that you can turn to adjust the temperature, adjust the position of the bed, all these things. It's also useful from a tax perspective, which we'll just barely scratch the surface of. But let's get into some examples here. But first off, who is seller financing for? It's for everybody. I've ran an analysis on all the deals done in Utah over the last year, and everything from mobile homes for $33,000 up to mansions in Park City, where they do the Sundance Film Festival, for $7 million. Everyone is doing seller financing, and there's a huge reason for it. But let's dive into some examples here. So this was my very first seller financing deal in 2019, I should say. This home was underwater. As you can see, not a very attractive home. Needed a bit of work. I would say the ARV, the after repair value on this home, was probably around $350 at the time. As you can tell, it needed a lot of work. The seller had a nice mortgage in place. This is a 4.5% interest rate, but they were underwater. This guy had bought the home a number of years ago, lived in it with his teenage sons. Life happens, right? Sometimes people get in tough positions, and this guy was underwater. He was $8,000 behind. He had no equity. If he tried to sell his home as is, whether it was to a flipper or an end buyer, no one's going to be able to pay him over what he owed. But what if you were an investor? If you were an investor at this time, and you could, how much do you need to put down as an investor for traditional financing? Anyone?
Usually 20 for an investor.
20 minimum, right?
20, 25.
Yeah. 20, 25%
Talking
down.
about conventional financing, right?
Conventional financing, exactly.
You guys agree with that?
Yeah.
Yep.
Okay.
Yes.
So this guy was about to let the home go to the bank. He had talked to other vanilla investors, and every cash offer he got was below what he owed. So he had lost hope. All of his hope was gone. He was in disarray. He didn't even have any money to go rent. So we came in. We made an offer that caught him up. We offered him $6,000 at closing. So we gave him $3,000 at closing, and then another $3,000 after he moved out. We had to hold a little bit of money in escrow, so that he had time to move out and to get into his next place. In exchange for that, he basically allowed us to take over his mortgage, not an assumption, but we took over subject to the underlying mortgage on a 10-year term. So for an investor, this is pretty attractive because you can get into this home for far less than you would through bank financing. The person that ultimately brought this to the finish line, the investor that brought this to the finish line, fixed it up, rented it out for a few years, and then in 2021, they refinanced it at a 3% rate. So they didn't even do the whole 10 years. But what do you think the advantage to the buyer, or excuse me, to the seller is here?
Before we answer that question, I need to understand. So you're saying that you gave him essentially $6,000 equity, caught up his back payments. I think you said he was 8,000 behind, so it was 14 altogether.
Yep.
So 14 altogether, 3 when he closed, 3 when he got moved out of it. 10 years, you did a wrap on it, subject to, so you wrapped the existing mortgage with a 10-year balloon. Is that what I'm hearing of his equity?
Correct.
Okay. All right. Go ahead, please. What was the question?
What would be an advantage to the seller on this?
Saved his credit.
Saved his credit. His credit would have been shot for 7 years, right?
Made a little bit of money down.
He made a little bit of money. Absolutely made a little bit of money. What happens when his payments are being made? When he goes from behind to his payments
Fix
being
the credit. Fix his credit.
exactly. It's
Going
fixed
up, yeah.
credit.
Lock it, please.
Assuming, you know, if this deal was a little bit different and he had just enough equity to zero out with cash, it does not, the banks do not look favorably upon, you know, you're behind and then you sell and cash out. But in this instance, his payments were caught up and then being consistently made for years. So, you know, if in a couple years down the road, he ends up in a position where he wants to buy a home again, he's in a far better spot to do that.
So just so I can clarify, the total that you paid for the property or the investor paid for the property was 264 because it was the balance of the mortgage, the balance of the mortgage plus 14. Correct?
Yes,
Okay.
exactly.
Okay.
Exactly.
Perfect. Thank you.
Okay.
And he was still on the title, right? Until
The title changed on this one, so that we probably won't have time to go into all the little details here of how title is done, because there's a number of different ways. I will say though, there's 3 main ways. You can do a lease option, which is kind of like a rent to own sort of thing. Title stays on the seller's name with that. You can do an executory contract. You may have heard that called a contract for deed, or a land contract. Or you can do the third option is an all-inclusive trust deed where the title transfers into the buyer's name. And we could talk for hours about the merits of those, but ultimately it's a conversation between buyer and seller. What's important to each person? What's valuable to each person?
and that didn't trip any do on sell clause with the bank, right?
And that's something we'll talk about as well as far as challenges.
sorry.
Yes, you want to
I'll
structure.
admit myself.
Sorry, what was that, Claudia?
Yes, I said I'm gonna mute myself because I'm moving too fast.
You're good. You're good. We'll try to have some time at the end here, but also I want you guys to speak up when you have questions or if you see anything, because again, this is like we're all collaborating right now, trying to conceptualize this and understand it. So if you have a question or a thought, someone else probably does as well. But to get through all of this, I got a couple more examples. So does anyone have anything else we want to talk about with this before we move on? Okay. These are kind of similar type of situations here, except these are fix and flip examples. So what happens if you're a flipper? How are you typically procuring money to buy a home and flip it? Anyone?
Hard money.
Hard money. Did you cheat, Debbie? Did you look at the bottom of the slide there and see
Yeah.
hard money?
Just telling the truth.
Yeah. Most people are doing it that way, right? Majority of people are buying with hard money. What do you know what rates are out your way, Debbie?
12%.
12%. There's usually some points up front, right?
Yeah.
Yeah. So out here in Utah, the standard right now is 2 and 12. So let's take a simple example of a $1 million home. You're paying 2 percentage points up front. So that's $20,000 just as a cost of doing business immediately up front. You're paying $20,000, and then you're paying a 12% interest rate. So 1% a month. You're paying $10,000 a month just to do this. Now, a lot of times, how often does someone need $1 million all at once, especially a seller, and especially a seller that's about to go rent?
Not
Need,
often.
realistically need, hardly ever, want maybe, but need, no.
Yeah.
Yeah, exactly. So, you know, let's break this down from a numbers standpoint. This is one I did myself a couple years ago. It was a home. It needed some love to get to the finish line, and you know, the move was to flip this and sell it to an end buyer. And I'm in negotiations with the seller here. You know, the situation. His mother had owned the home. His mother had owned the home in Utah for a number of years. He was born in this home. He since started his own family. Was living in Vegas. Started a family there. Mom's getting old. Mom moves in with him in Vegas. This home's just sitting here vacant, collecting dust. They don't have an immediate, you know, I say, hey, Mr. Seller, we'll omit names here. Hey, Mr. Seller, what are you going to do with this money? I can pay you all cash. We can find a way to do that. But what are you going to do with this money? Oh, well, nothing. We don't have immediate plans for it. Maybe in a year or two, we'll be moving, but we don't have immediate plans for it. So it's just going to sit in the bank, pretty much. Okay, well, you know, we talk numbers back and forth. 280 is what we could pay on this if we're going cash. But hey, the bank's paying less than 1% right now. You know, it'll probably take me and my partner or whoever I do this with 6 months to get through this. I want to build in a buffer so I'm safe. So what if we do an 8-month term here, and instead of paying you $280,000, I pay you $290,000, and you let me pay you out over time, over 8 months. So look at the difference here. Hard money on this second line down. 6 months of hard money is $22,400. Obviously, everything else is the same. Just through him willing to be the bank on this, he saves me $12,400. Not a small amount of money, in my opinion, and it would be bigger in California. And I get to pay him an extra $10,000. How do you think he felt about that?
He should have felt pretty good.
He felt pretty good. He had nothing he was going to do with that money. You know, he was excited. He was excited to make an extra 10 grand. He was excited for me to make extra money. Everyone wins on this except the hard money lender, right? Sorry, taking your business hard money lender, because we were able to work something out that was advantageous for both of us. All right, so let's dive a little bit deeper. Some of you that were there last week probably recognize this, because this is what we used last week. So on the right side here, we have the underlying mortgage. All the basic elements of an underlying mortgage, right? We have principal and interest. We have our interest rate. We have taxes. We have insurance. All that combines for our PITI, our total payment. This is a friend of mine. A friend I know through basketball. He ironically works at Fidelity as well. This was the first home he bought. He's getting kind of sick of being a landlord. And he's thinking, I wonder if there's a better way to do this. It would kind of suck to cash in that 3% loan and not get an advantage on that anymore, right? But he doesn't exactly want to be a landlord, and he likes the idea of passive income. So, what do you think if you had a buyer right now? How do you think they would feel about getting a home at a 5% rate?
Anybody sell a house with a 5% mortgage right now?
Yep, let's do it.
All day,
In front
huh?
of you. Yeah.
No brainer. And again, back to last week, this is an example where we can increase our purchase price. If we are offering this massive advantage to a buyer, a 5% rate, you know, maybe we can sell the home for about 5% more. So that's what we've done in this example. So on the right side, we have their underlying mortgage. And on the left side, we have the proposed financing. This deal hasn't closed yet. We're kind of in the infancy of it right now, but I want to show a few different ways that we can basically manipulate the different terms of the deal, turn the dials so that it's amicable to each party. And I'm going to show you a couple different examples with the same home of how we can play around with those dials.
So Nick, hold on a second. Let's make sure we're all grounded to this chart because we saw it last week. It's the same format. Let's go to the right side, the underlying mortgage. You've got a current balance of $294. Top line, everybody good with that? Their
Yeah.
principal and interest payment right now is $1,353. Insurance is $92. Taxes are $150 for a total payment of $1,596. The rate is 3% on their underlying.
Yeah.
They're proposing a new loan, purchase price of $472 with a down payment of $82. Loan amount $389. So right off, you have almost $100,000 in difference between the principal on the underlying and the principal on the new loan, right at that number.
Yep.
Little 5,000 less, or is it 5,000 more? Anyway, about 100. 10 years, 120 months, payment of $2335. So they're financing $100,000 more for only $800 a month more on that equity portion that they're financing. Okay, interest rate 5%.
And how much is
So-
the balloon payment?
The balloon, you'd amortize down that at 389. So whatever that is at 5% at the end of 5 years.
And that, is it pronounced Claudio, or how do you say it?
Claudio, yeah.
Claudia.
Claudio.
So on the next slide, I'll show you that. I wanted to keep it as simple as possible on this slide, just to familiarize ourselves with the
Okay,
terms.
good. So you'll see that in just a second, Claudio. Go ahead, Nick,
Yeah.
please. Let's keep the
Go ahead.
pace.
Can I ask you a question? So
Please.
this one is existing mortgage, and then equity part seller is gonna carry, correct? So or
The- The
It's
seller's
the-
gonna carry, yes.
the equity. So the total, the purchase price is 472,500 plus 294, 274, right?
No, the 472 includes the 294.
Oh, okay. Oh, okay, got it.
Yeah, so in this instance, you'll see the down payment, 82,000. That's the buyer. I think it was I went with 17.5% down. And that's why the 472,500 minus 82,688 equals 389,813. So that's that 389,813. That is what we will start amortizing over the course of 30 years. Any questions about this part? Because this is kind of foundational before we don't want to go into the next
We all
stuff.
good, guys? Anybody have a question?
Yeah, I have one more question.
So
Sorry.
you're wrapping this?
Yes.
Yeah.
Okay.
Go ahead.
What is
Amanda?
what are the balloon payments then if you're doing it over 30 years?
He's going to show that in just a minute.
That's
Coming
the-
up on the next slide.
Yeah,
okay?
great question. So yeah, it's amortized over 30 years, but maybe my friend, the seller, doesn't want to keep his name on the loan for 30 years. Maybe he's got some plans 10 years down the road. So we say here in 120 months, which is 10 years, the buyer has to pay off everything, whether they're going to sell it, refinance it, whatever they're going to do, that's the end of the term there. So that's what the 120 means. And again, this is another point that can be negotiated here, as I'll show you in following slides, following examples. So this is the exact same scenario. I'm just adding a little bit more to it. So those top two cells are the same. I'm showing there's a benefit to seller financing here. If you are offering something very attractive to your buyer, for example, a 5% rate, you're going to be able to increase your purchase price. And what happens by offering these terms? What are the resultant benefits for the seller on this? Well, for one, if you look at the very bottom cell or the very last bracketed cell, the difference between those two payments, payment that they are currently paying the bank and the payment that they are receiving from the buyer, the difference there is $738 per month. I assure you, he was not making that much being a landlord. He wasn't making even close to that much being a landlord. Now, also, if he was to sell this home right now, he's a savvy guy. Like I said, he works for a big financial firm. So he knows different ways to invest money. Does anyone know how to get a 14% rate of return right now?
Oh, Nick, you're asking the wrong group.
All right. Aside from you guys, do your vanilla seller clients know how to get a 14% rate of return in 2014?
No.
No. And actually, I would say this is theoretically higher than a 14% rate of return, because that number is calculated factoring in the extra money that they're selling their home for, that $22,500. That's factored into this calculation. If we say, hey, actual appraised value, that number is even higher. So this is.
Can I dwell on that just a minute? First of
Absolutely.
all, what I'm seeing here, and correct me if I'm seeing it wrong. This guy, if he has good credit, which he probably does if he's been a landlord, he can go out and borrow at 7 tops today. So he can go borrow that equity on his next purchase at half the price, at half the rate he's getting on a return here, which means that payment would pay for 2 times that much debt on his next house with his credit.
Exactly. And that's the beauty of it. I wish we had 10 hours to have this conversation, because there's a way to show you can transfer this benefit basically into your next home and significantly make things
Reduce your
much more
costs.
attractive.
Yeah, reduce your cost of owning the next home. One other thing, the seller finance benefit, the 22.5, the premium we're putting on the house for providing the financing. We can look at that two ways, guys. I can look at that and say, wow, that's $22,500 over 10 years. That's another, you know, if that's a 17%, you said, Nick, that's 1.7% a year added to the 5%. So my cost of financing really isn't 5%, it's 6.7%, which is pretty much up there. However, is that true? Because that's the price of the house. Who believes that house will most likely be worth $450,000 in or $472,000 10 years now? Who's actually going to pay that portion of that cost of this financing? It's going to be the next owner. It's not going to be this guy. He'll get that out of appreciation. So he's getting a benefit of his future appreciation in advance by saying yes to that in order to get this financing and a payment that he can handle. That doesn't even say what he can do with the difference in payment that he would have put into this house if he'd as compared to how he would finance it conventional. Is that making sense? Are you following me, everyone?
Yep.
I'm seeing heads nod. Okay.
Yeah,
Go
yeah,
ahead.
yes.
Exactly, Wayne. Exactly. Thanks for chiming in with that. It illustrates it perfectly. The last two things I'll add before we go to the next slide. So the present equity in this last cell here, $73,038. So that's their equity right now. But when this balloon payment happens at year 10, that equity grows and they will get a balloon payment of $109,000. So
Okay,
why?
so time out. Why is that, guys? Why is that?
Time value of money.
Time value, that really masks the full answer. You're right, Deb, you're right. Time value of money vis-a-vis what? What's happening with those two loans that are in place on that house? You've got, as Miho said, the underlying, and you've got the wraparound. The underlying is X number of years into its amortization schedule, right? So how much debt, how much principal is being paid on the underlying, more or less than the new loan?
More.
So that equity for that seller that financed this is growing every month. Every time a payment's made, that loan's going down faster than this one is. So when this one pays off at its balance of 109 years out, he's going to owe less than. And is that factored into that 109? Is that why it's 109 instead of the equity corridor it started out with the 73?
Yeah, exactly. Because one is paying down faster than the other. So yes, it's those differences are growing each payment. And that's why it grows from 73 to 109.
Mhm.
Okay, so I just want to make sure I'm understanding correctly. So both of the names, both the seller and the new owner are on the mortgage now, right?
The mortgage, the original mortgage
Or
stays.
title.
It's the same.
Okay, there's two different questions, Amanda. No, they're not on title. The seller is relinquishing title, deeding the house to the new buyer.
Okay,
But his name does stay on the mortgage. He is still obligated on that mortgage. What does he get to do if this guy doesn't pay him?
he still has
Foreclose
to-
and keep his $82,000 down payment?
so that's why he can take whatever he now has equity in his part of the mortgage. He can use that towards another property, correct? Is that what you were saying?
No, he can't really use it up front, but because he's leveraging that equity in there and getting a 14% rate of return on it, he can go borrow the new money with his credit, whatever his credit will bear, and he'll pay no more than 7 in today's marketplace. Say he goes and gets a 95% conventional loan on his next house. He's paying 7% on that loan, and he has a 14% head start on the equity portion that he left in the other house.
Okay.
He's making money on this one to subsidize the new one. Does that make sense?
I think so.
Making his payment on the next house effectively lower and his cost on the next mortgage effectively lower.
Exactly. So let's say, Ryan, that his new home, let's just say his PITI in the new home is $4,000. Well, $4,000 minus 738 is a lot easier to swallow. You know, that, what does that put it at? 30, 32
33.
change,
Mhm.
a lot more palatable. And I'm gonna skip ahead a couple slides here.
By the way, Ryan is Amanda. Ryan's at work. She's hijacking his.
Okay.
Yeah,
I
sorry.
didn't think about
I
that
didn't
for a
realize that was his
second.
name. I was like, who's Ryan? Okay.
I was like, I know a couple of females named Ryan, so I'll
Yeah,
roll.
me too. Me too.
So I'm going to skip ahead a couple slides just to illustrate what's happening here. Those of you that were there last week might recognize this. But again, we got two different mortgages here. We got the underlying mortgage on the right side and the new mortgage that's being created on the left side. Now, this is a very creative example. You'll notice on the left side, the term section, we're doing a 99-year amortization here. Just for fun, you know, the seller on this, you know, they don't need much right now. They want more interest. So
So there is no amortization in 10 years. 382.5 starting out, 382.465 10 years from now.
yeah, exactly. They're hardly paying anything down. Look at the principal payment each
Nickels
month
and dimes.
is nickels and dimes. So in this instance, this, for those of you that are new that weren't here last week, the reason I pull up this slide is because it shows what happens each month, right?
Mhm.
You got the 3% mortgage. A big chunk is being taken out of that balance each month. 618, 619, 621. That is being paid down relatively quickly. But in this example over on the left, hardly anything is being paid out. But what is the advantage to the buyer of doing a 99-year term?
Keeps the payment down.
It keeps the payment down. Exactly. If
Why
this-
didn't you just go interest only?
We could. That's absolutely an option. And I'm glad you said that, Chuck. And that's why Wayne and I and Debbie and everyone who does this stuff gets so excited, is because there's just a million different ways you can do it. And you can put everything out on the table and see what's important for everybody and structure it accordingly. Does this page right here, by the way, make sense to everybody? The amortization, like, does this help, or does it not make sense to anyone? I guess I should ask.
I feel like it made everything just click. Like I get it now. So
Yeah, this part's important to see, like,
Good,
on a
good.
monthly basis. Yeah, and I probably should have put this first, so my apologies, Amanda. But also another thing to note here. So I changed the term. I said, hey, let's only do it for 5 years here, just so we can spin the dials and see what results, what changes when we spin these dials. So we said, hey, let's do a balloon payment in 5 years. You got to refinance, sell, whatever. You got to be done in 5 years. So let's go back to the blue, the return on equity, that cell on the right side of the page. If you remember on the last one, there was not as much of a payout at year 10 as there is at year 5 on this one. And that's because of what Wayne was just talking about. We're barely paying anything down on the new loan, but we're still paying a lot down on the 3%. So that gap between the equity corridors is growing. So in 5 years, that's why so much is being paid out. And it's also why our return on equity is higher.
So guys, tell Nick the secret sauce here. All together, more sooner is
Better.
better. The faster you get it, the higher your rate of return.
I like that. I don't think I've ever heard it phrased quite that way.
Chapter in the book called Make My Money Mobile goes into that.
I like it. I don't think I've read that chapter yet, so I'm gonna have to go into that. All right, on this page in particular, do we have questions?
Sounds like we're all clear.
Okay. Let's see, we're running out of time. Is this one that we want to skip? Let's see. All right. I'm going to try to go through this real quick. I won't talk numbers as much, but the examples I showed were conservative. How many people do you think want to live the American dream of home ownership, who make good money but aren't bankable?
A lot.
Probably
There's-
20-30% of the buyers.
There's a lot of people out there. There's a lot of people, whether they work in construction, whether they're an immigrant that doesn't have the proper visa status or documentation, whatever it may be. There's a lot of people out there, including probably some of you guys who are 1099 employees who get scrutinized a little bit more hard, and it's difficult for you to be bankable. What if someone was out there that wanted to take advantage of their low interest rate mortgage while simultaneously affording one of these people to live the American dream? The benefit on this slide is even bigger than the previous ones. We're almost at a 16% rate of return on our equity, almost $1,100 a month. On a passive basis here. If you're a landlord, you have a lot less protection. You don't have $67,000 down protecting you. You have first and last month's payment at best. You're not cash flowing like this. Lots of advantages. And because we're tight on time, I won't go into a ton of detail, but is this helping with the vision here?
Yes, for
Everybody get
sure.
it? This is a review of the other two, right? You got it?
Yep, we're
That's
just changing things. We use a 6.5% here, which is still a whole percentage point better than what's available through a bank. So you can imagine that there might be scenarios where you could potentially increase that. You might be able to do a 7.5. And the only reason I don't show 7.5 is because I haven't done it myself.
So
But
how are you coming up with the new interest rate? Is that just what is decided from the seller?
Yep, exactly. This is a conversation. The two parties get together. Hey, what's important to you? What's important to me? Let's collaborate. Let's work on this together. And we're saying, hey, this is what they came up with, is 6.5%.
Gotcha.
Good question. Yeah, this is not a set number. This is entirely negotiable.
And also depending on what the banks are going for at the time, right?
Exactly. Exactly, Debbie. It's entirely a part of it is dependent on what's the alternative.
Yeah.
Yeah, if you can provide a more attractive example than the alternative, then yeah. I did one last year where I played middleman on it. And let's see, we did a 28.775 year amortization, because that's how specific we got on, hey, we need very specific payments here. So that's the beauty of the collaboration on this. In that home, they had no chance of selling it. This was a deal that I found through a colleague on the MLS. It had sat for months. No one was buying it. They were asking too much. They couldn't get what they want. And I proposed, hey, I know I can find someone here.
That sound familiar, guys? You seeing that in your marketplace?
Sure.
Buyers sitting with their properties, need to move on, want to move on, can't move on because they're held hostage by the financing structure. Introduce
Yeah.
private financing. Here it is. Here's your tool.
But I do have a question though. How do you secure a buyer if, for example, the buyer is making all the monthly payments, but then the seller decides one day not to make the monthly payments to the bank, and then I don't know, 6
I
months
love your
back
questions.
discuss.
I love your questions. I'm so glad. Yeah, you guys are
Sure.
asking questions that this gets, I think Wayne was about to say it, but it gets run through a third-party escrow company. They
Okay.
charge you a nominal fee. There's one in Utah. They charge I think it's $20 a month now, $100 setup fee, and all the accounting is done for you. So the buyer sends a payment to that escrow company. The escrow company then sends the $1,596 to the mortgage company, so that gets paid for, and then they send the rest to the seller.
Right. Okay.
All right. One last example here.
And
got-
then this is all an example of like the wraparound loan, not the assumable, correct?
Yes.
Correct.
Okay.
Correct. And assumable, you are qualifying for and officially taking over the existing financing. Once it's done, the seller is gone, they're out of the equation. This one, we're saying, hey, there's a motivation for the seller to stay involved here.
Nick, are you gonna talk about the due on sale clause like Claudio asked earlier?
Yes, very briefly, given that we have limited time, only briefly, but we will talk about that because that, to me, that is the biggest hurdle. Well, not the biggest hurdle, but it's like the part in the back of the mind, right? That you got to
Mhm.
worry about.
Well,
Is how-
all we need to know on that, Nick, is bottom line, how do you handle it? They know the hurdle, they know the issue. So just tell us how you deal with it, please, when you get to there, but we do need to keep moving.
Yes, you got to have plan B, right? So, you know, you either have to be someone who is maybe some private money. So basically that gets called due. Man, this is such a big topic. It's hard to condense, but basically if this, then that, you know, you need to have some ideas regarding how you're going to do it. Do you need to enlist a credit partner? You know, maybe you have a credit partner who's there just in case, and they're making a nominal fee that you're paying them to jump in the event that happens. Or if it gets called due, you might need to sell the home. Or you might need to, hopefully you're bankable by the point that happens. And then you
That's the
refinance.
seller, not the buyer, right?
Well, yes. I mean,
One of them.
seller, if the seller fails to remedy that, personally, if I'm the buyer, or sorry, if I'm the seller, and that gets called due and I have a big enough down payment to protect myself, I'm not terribly worried because if I've collected more of a down payment to produce an equitable position, then I can basically take the home back and sell it, right? It's when you don't get enough down that you put yourself at risk. So this is a conversation
For
that
another
needs to be
meeting.
had. Sorry, go ahead.
That's a conversation for another meeting.
It's a conversation for another meeting. Yeah, it's kind of hard to go into all the different scenarios here. I mean,
Yeah, as I think I had to go through that with some of my clients, both what we talked last week and what we're talking right now, and I guess these were like the breaking points, how to manage, because
Yeah.
they didn't know how to deal with that.
so maybe this is a collaborate. You know, maybe this is something we can talk about in
Talk
depth
up the-
another
yeah.
time. It is
For sure.
pivotal. In
Mhm.
fact, I would argue that without the due on sale clause, there's a lot seller finance would be a no-brainer.
Yep, exactly.
Almost always. Anytime there's a
Exactly.
3% loan with minimal equity, seller finance would be an absolute no-brainer.
Mhm.
And this would be one of those instances right here. This is a VA seller, or sorry, yeah, VA seller bought the home. You know, they had the VA funding fee, which tacked on an extra 2.15% to the purchase price or to the debt that they were financing. So these guys have no equity. They can't sell the home right now. But back to the principle that we were just talking about, if they offer the home at a 5.5% rate, not only are they able to sell their home, which they couldn't do before, but they could get an infinite rate of return on their money and make $450 a month just by willing to be the bank here. All right, we're going over on time. I appreciate you sticking with me. Briefly to talk about challenges, some of which we've already covered, is one of them is complexity. You know, this is not vanilla. It's not for everybody. And I'm having those conversations up front. You know, this is not something you push. this is something you offer. You know, there's a lot of tools to get deals done. On some of the ones that are harder to get done, this is something I'm offering. And if I have a 2-hour meeting with a seller, you know, I'm asking them to get their mortgage statement, and I'm plugging it into the spreadsheet that I have. I'm saying, hey, you know, here's something that we may want to be open to from buyers. But not everybody's brain works this way. You guys are in this meeting because your brain works this way and you can handle this stuff, but it's not going to be for everybody. There's an ongoing relationship here. It's not like a high buy, you know, you do a normal deal, they're gone, the seller's gone, but there's an ongoing relationship here. So, you know, you need to mitigate your risk. Your paperwork's a little bit more complex. Conversations need to be had. If this and that, you need to make sure those dots and the unknowns are connected. You need to know what's going to happen under different scenarios. So it's not for everybody, it's not vanilla, but for the people that it clicks for and that it makes sense for, you know, you may be able to stop a short sale by doing this. I think there can be some short sales around the corner again with the market that we're currently in, and this is another tool that you guys can use. So we're right at an hour here. There's a million things we could talk about, but what do you guys want to talk about? What questions do you have?
I guess I had my questions.
Thank you for participating that way, Claudio. Anybody else? Appreciate you
sorry.
asking. I know you guys have varying levels of understanding here. Most of you understand it better than most. And so some of it maybe is old hat, but let me just summarize if I can for the sake of time and for wrapping it up here. Nick, good presentation. And we do understand, we get just listening to you and seeing it. There's a lot more to this. And of course, you're the guy that they can go to get that more and to go deeper if they choose to, with a specific transaction especially. So the bottom line is he has the tools. He can provide you with those tools and show you how to use those tools so that you can start closing transactions that aren't otherwise closable, so that you can get properties moved on the market that are just sitting. The key to moving them is sitting right there recorded against the title of the property. It's called a low interest mortgage. And he will show you how to convert that to the reason that house sells, while at the same time putting a fence around the risk that would be there. Nick, have you ever actually had one of these the loan called by the lender? Have you ever seen that?
I've heard of it. You know, I participate in different groups where this is heavily discussed, and it sounds like I've heard anywhere from 1 out of 100, 1 out of 500. Some people
That's
think
probably about right, because in the half 100 years I've been doing it, I haven't seen one. So I guess I'm not quite here long enough to see my first one. If it's 1 out of 100, Debbie's laughing.
Oh, I was asking because I have a situation right now that we'll discuss maybe on private afterwards, that I can come over, and that was the main problem, the do on sale clause and if the buyer is not making the payment, but I understand through an escrow would work. So yeah.
One of the things that I've seen them do is that doesn't get called, is that going in, especially if they have it under management already, they just become a new manager. And so it's like property management, and all of the checks are flowing through. So the buyer turns out to, be making the payments themselves. So it's not left up to the seller.
exactly. And also, let's think about the bank's motivation here. Foreclosing is a painful process for the bank. You know, the banks are in the process of loaning money. I would propose that, generally speaking, I'm not saying you're bulletproof to the due on sale clause. It's always, I'd always keep it in mind. But for the most part, the banks don't want to go through that process. If they have a performing asset, typically it's not going to be in their best interest to take a a performing asset and make it a non-performing asset and deal with all the trouble and hassle that goes with that.
Let me tell you how big that trouble and hassle is. We just closed that construction loan on the storage units for 1.27 million. The bank required that the borrower put up $200,000 in interest reserves in the bank to pay the interest through construction and through lease up. That looks like, that's just tough financing for the times, but it's transparent to me. I know exactly what that bank is doing. And they stressed, you must make that deposit before we close. So when my borrower goes in there and puts $200,000 in that bank, the next day the bank can draw $2 million from the Federal Reserve. So they get to make that loan for 1.3 rounded up, and they have $700,000 left over to put in credit cards or something. Now, let's take the reverse. When they call that loan due on that house and it becomes a non-performing asset, they have to cough up the $2 million to the Federal Reserve. And that can put them in really bad straits with their reserve requirements and things. That could put them on the audit list for the feds. And there are lots of reasons they don't want to call that loan. We probably worry too much about it, but I'm also not part of the casual crowd. Oh, it's no big deal. They don't get called. You don't have to. No. This is real legal risk here. Let's build a fence around it.
In my case, the sellers have like a lot of equity in the house. So this example for them could afford them to move somewhere else where they want to move and pay the whole new mortgage or the whole new rent or something.
Yeah.
Because the equity is so big.
Well, if the buyer's not
house.
paying, just foreclose. That's simple. The seller's still in control.
Okay.
And what's the bank going to say? Yeah, we're going to call it anyway. Really? When
Yeah.
I'm solving the problem for you, you're going to call it. They probably won't. They might rattle a saber, but I doubt they'll pull the trigger.
Well, we'll talk about it after the meeting then.
Yeah, different conversation.
So the due on
Yeah.
sale clause, sorry, I might have missed this earlier, but the due on sale clause is to the seller on their
It's
current
between the
loan,
seller and the
right?
bank.
That's what we're talking
Yes.
about.
Yeah.
Mhm.
Yeah.
Okay.
And this seller finance would probably say it's non-assumable too, I would imagine. You don't want to pass it on to third parties, do you, Nick?
Sorry, one more time, Wayne.
The wraparound, the seller financing is in place. That new buyer can't just turn around, flip it to somebody else and leave that financing in place, can they?
It is negotiable.
Yeah.
I've done it before. I mean, I bought one on seller finance a couple years ago. I didn't want to flip it, so I went and sold it to a flipper, and we figured out our terms. And I said, hey, here's what we got. Just to let you know, if you're a day late, I'm coming for you. So it's all negotiable. You have very explicit conversations. Yeah, but you don't have to. Yeah, it's up to the seller what they want to allow.
Yeah, and let them know they've got to wear their big boys and girls britches to the closing because they're taking on real responsibility.
Contracts have consequences.
That's right. All right, good job, Nick. Thanks, everybody. Thank him, please, for his time today. And who knows, they might want you to come back in the future. But thank you for both weeks. And you've given us a drink out of a fire hose. We'll see if we can swallow some of that and make some sense of it, and then see where we go. The guys, try to find some opportunities out there. You'll have Nick's contact information. If you have specific situations, feel free to call him, text him, email him, and say, hey, can you talk me through this one? That's why he's here, and you can work out his fee structure on doing that with you. I think he's willing to ride shotgun until the closing, so you're not going to have to advance anything up front. But talk about how he gets paid and how you can get paid more by making some of these go forward, okay?
Perfect. Thank you so much.
Sorry, did we get your contact information already?
I
Or are you
should
gonna
put
send
on
that
a
out?
slide.
We'll get it to Miho and she'll send it out.
I'm gonna
Okay.
put it on the
Right, so
on
Nick-
the
Thank
group.
you.
Email Miho with it and she'll send it out to everybody. All
Okay,
right?
I'll get your email from.
As
or
long as you're
Miho's
okay with
email
that.
from you. Absolutely.
You should
Perfect,
have,
thank you.
did you not get an email from Miho as a presenter?
I don't think I did.
I'll make sure you have it. Don't worry about it. We'll make sure you get it.
All
All right, guys, have a good week. We'll see you all next
Thank you,
Thursday.
guys.
Yeah.
Thank
Thank
you.
Thank you.
Thank you,
Bye.
guys.
Thank you, Nick.
Good
Have a
job.
great
Have a